In 1989, 1 square mile of Tokyo was worth more than all of California. Then, it all vanished. This is the financial mistake that trapped a generation. In the late 1980s, the world looked at Japan with a mixture of awe and envy. Its economy wasn't just growing, it was defying the laws of financial gravity. This was the era of Japan Inc., a global powerhouse of manufacturing and technology, seemingly destined for permanent prosperity. At the heart of this confidence was a belief system built on assets. Not just any assets, but stocks and land. In Tokyo, the price of commercial real estate had tripled in just 3 years. The stock market, the Nikkei 225, seemed to only move in one direction, up. At its peak on December 29, 1989, the Nikkei closed at 38,915. Around that same time, the value of the land underneath the Imperial Palace in Tokyo was estimated to be greater than the value of all the real estate in the entire state of California. It was a time of unimaginable wealth, a national euphoria where it seemed everyone was getting rich. But it was an illusion, and when it shattered, it didn't just cause a recession, it triggered a multi-decade period of economic stagnation known as the Lost Decades. It trapped millions of ordinary citizens in a financial prison of their own making. The question is not just how this happened, but what fundamental rule of money was broken on such a catastrophic scale. The story of Japan's asset bubble begins not in Tokyo, but in New York City. In 1985, at the Plaza Hotel, the world's 5 largest economies met to address a problem. The US dollar was too strong, hurting American exports. They signed an agreement, the Plaza Accord, to intervene in currency markets and devalue the dollar. The plan worked. In fact, it worked too well. The Japanese yen began to appreciate with breathtaking speed, nearly doubling in value against the dollar in just 2 years. For Japan's export-driven economy, this was a disaster. Suddenly, Japanese goods, like cars and electronics, became vastly more expensive for the rest of the world. To counteract the economic shock of a strong yen and prevent a recession, the Bank of Japan responded with its most powerful tool. It began aggressively cutting interest rates. By 1987, the discount rate was slashed to a historic low of 2.5%, and money became incredibly cheap to borrow. This decision unleashed a tidal wave of capital into the Japanese economy. Banks, flush with cheap funds, needed to lend it out. Corporations, able to borrow for next to nothing, took on massive loans. But they weren't just investing in new factories or research. They were looking for a better return. They found it in the stock market and in real estate. What followed was a speculative frenzy unlike anything the modern world had ever seen. The Nikkei index, which had been trading around 12,000 when the rate cuts began, embarked on a near vertical climb. In 4 years, it more than tripled. Corporations discovered they could make more money through financial engineering, or Zytec, than through their actual business operations. They would issue bonds at low interest rates, then pour the cash into the stock market for a guaranteed higher return. Everyone was a financial genius in a market that never went down. The mania was even more intense in the property market. A powerful cultural belief took hold, known as the land myth. The argument was simple. Japan is a small, crowded island nation. They aren't making any more land. Therefore, its value could never, ever fall. This belief disconnected property prices from reality. People were no longer buying homes to live in or properties to rent out for income. They were buying them on the simple assumption that they could sell them to someone else for a higher price in the near future. Stories were common of ordinary city plots selling for millions of dollars. Golf club memberships, treated as a tradable asset, were selling for hundreds of thousands. Ordinary citizens were swept up in the hysteria. Banks made it easy, offering loans for 100% of a property's value, sometimes more. The media celebrated the new wealth, profiling overnight millionaires. To stand on the sidelines was to feel foolish, to miss out on a once-in-a-lifetime opportunity to secure your family's future. The system fed on itself. As stock prices rose, the value of a company's assets on its books increased. This allowed the company to borrow even more money from the bank, using its inflated stock portfolio as collateral. They would then use this new loan to buy more stocks and more real estate, pushing prices even higher. It was a perfect feedback loop of debt and speculation. The entire economic structure was balanced on a single premise, that asset prices would rise forever. No one stopped to ask what would happen if they didn't. What would happen if gravity finally reasserted itself? In 1989, a new governor, Yasushi Mieno, took the helm at the Bank of Japan. Mieno was a career central banker, a hawk who watched the speculative excess with growing alarm. He saw a nation addicted to cheap debt and a bubble that threatened to destabilize the entire economy. He believed it was his duty to stop it. Mieno wasted no time. Starting in May of 1989, the Bank of Japan began to raise interest rates. Then it raised them again and again. Over the course of about a year, the central bank hiked rates 5 times, more than doubling the cost of borrowing. The era of free money was over. The pin had met the bubble. The fuel for the speculative fire, cheap debt, had been turned off. For those who had borrowed enormous sums, the math suddenly inverted. The cost of servicing their debt was rising, just as the assets they bought with that debt began to look dangerously overpriced. The stock market was the first to break. After hitting its all-time high on the last trading day of 1989, the Nikkei began a relentless collapse. By the end of 1990, it had lost nearly half its value. Panicked investors who tried to sell found there were no buyers. The illusion of liquidity vanished overnight. The property market, as it always does, moved more slowly. Prices peaked in 1991 and then began to slide. But unlike the stock market's dramatic crash, the real estate decline was a slow, grinding torture, a fall that would not find a bottom for over 15 years. This is where the story shifts from a financial event to a human tragedy. Consider the life of a typical salaryman, an office worker in Tokyo in 1990. Encouraged by his bank, his employer, and his society, he buys a modest apartment for his family. He takes out a 100 million yen mortgage, an enormous sum, but manageable so long as his salary kept rising and the property value increased. But neither of those things happened. As the economy stagnated, wages flattened, and the value of his apartment began to sink. Within a few years, his 100 million yen loan was secured against an asset worth only 60 million yen. A decade later, perhaps only 40 million. He was trapped. He could not sell because the proceeds wouldn't even cover half of his loan. He could not move for a better job. His entire financial life was now dedicated to servicing a massive debt on an underwater asset. He had followed all the rules, done what everyone said was the smart thing to do, and he was financially ruined. Now multiply that single story by millions. An entire generation of Japanese citizens became debt slaves. They spent the prime of their working lives shackled to the financial decisions they made at the peak of a mania. This had a devastating effect on the wider economy. Trapped in negative equity, people couldn't spend. Consumption collapsed, and the economic engine of Japan sputtered to a halt. The companies that had played the Zeittech game were also caught. Their stock portfolios were worthless, and their real estate holdings were massive liabilities. Banks that had lent them the money were now facing a tidal wave of bad loans. But the problem was so systemic that if the banks foreclosed, they would trigger an even greater collapse. So they didn't. They propped up failed companies with new loans, pretending they were still viable. These became known as zombie companies, the walking dead of the Japanese economy, sucking up capital that could have gone to new, innovative businesses. The entire system seized up. The lost decade of the 1990s stretched into a second, and then a third. The Nikkei index, which peaked near 39,000, would eventually bottom out below 8,000 in 2009. To this day, more than 3 decades later, it has never returned to its 1989 peak. The landscape of Japan's major cities still bears the scars. Bubble-era buildings, financed with cheap debt, were often sold for less than 10% of their construction cost. The generation that bought at the top saw its dreams of wealth and retirement evaporate. So what was the fundamental mistake? It wasn't buying property, and it wasn't investing in the stock market. The mistake was a collective failure to distinguish price from value, funded by an immense amount of debt. An asset's fundamental value is tied to the income it can produce. For a stock, it's a share of the company's future profits. For a building, it's the rent it can command from tenants. During the bubble, the prices of Japanese assets became completely detached from these fundamentals. Prices were instead determined by pure speculation, by the belief that another buyer would pay more in the future. This is what economists call the greater fool theory. The problem is that eventually, you run out of fools. Debt was the accelerant poured on this fire. It magnified the mania on the way up, allowing people to buy assets they couldn't afford. But on the way down, it magnified the pain, locking people into inescapable losses and turning a market correction into a generational catastrophe. The Japanese land myth was broken. The rule that was forgotten is one of the oldest in finance. Trees do not grow to the sky, and prices that are unmoored from underlying value will always, eventually, return to earth. The only question is how much damage they do on the way down. The story of Japan's asset bubble is not a criticism of a nation, but a timeless case study in human psychology. The forces that created it are not unique to Japan in the 1980s. They are present in every market and in every era. The combination of cheap money, a compelling narrative, and herd behavior is the recipe for every speculative bubble in history. It creates a reality distortion field where prudent questions are dismissed and skepticism is seen as a failure of imagination. The ultimate lesson from the financial ruin of millions of ordinary Japanese citizens is a sobering one. The greatest financial risk is not missing out on a boom. The greatest risk is taking on massive debt to buy into that boom at its peak. Because when the music stops, the debt remains. The promises of permanent growth are revealed to be hollow, and the consequences are paid not by the system, but by the individuals who were convinced, for a short and brilliant time, that the old rules no longer applied.